Hi, I'm Therese from NESS Super, and today we're going to look at the insurances you can hold within your NESS Super account. Before we begin, it is important that you understand that the information provided is correct as at the date of our recording, and that this information can change over time. The content is also general in nature, and as everyone has different personal, financial situations, objectives and needs, you do need to consider this before making any insurance decisions. So what are we trying to accomplish? Well, we would like you to be able to walk away knowing the types of insurance that you can hold within your NESS Super Fund and what they cover. We would also like you to understand the importance of considering the level of cover you hold and the situation you and your family may find yourself in the event of death, illness or accident. We would also like to spend some time explaining NESS's insurance offering. Firstly, let's look at the types of insurance cover that you can hold within your NESS Super account. There's death cover, which includes terminal illness cover, total and permanent disablement cover or TPD, and income protection or IP. Now, with death insurance or life insurance cover, it's payable in the event of your death. It doesn't benefit the person whose life is insured. It's meant to provide for those that you leave behind. That is your dependents, an example being your spouse or your children. Now, as this insurance cover is held within Super, the claim proceeds are paid into your Super account as a lump sum, and the balance of your Super and the insurance proceeds are then paid out to your beneficiaries. Now, as the benefit is payable to your beneficiaries, it is important that you have them nominated on your superannuation account. Otherwise, the trustee of the fund will be required to identify all potential beneficiaries who might have been dependents and then look at their relationship with and the extent to which they may have been financially dependent or interdependent on you at the date of death. And then they decide who to pay these funds to. Now, if you have death cover with NESS and you are diagnosed with a terminal medical condition, you may be eligible to receive a terminal illness benefit, which will be paid prior to your death. Two doctors, one specialising in the field to which the terminal illness relates, has to certify that an injury or illness is highly likely to result in your death within 24 months. Now, with total and permanent disability insurance, or TPD, this is payable in the event that you are unlikely to resume your previous occupation or engage in gainful employment for which you're reasonably suited by education, training or experience due to illness or injury. Now, if this insurance is held in Super, it is also paid into your superannuation fund as a lump sum, and the insurance proceeds can then be released to you. There could be lump sum tax payable if these funds are accessed before age 60, but concessional tax treatment does apply. Now, income protection or IP is different to death and TPD insurance. This one actually pays you a monthly benefit if an illness or injury stops you from working temporarily. Think of it as a wage replacement safety net while you recover. It's paid for a limited time period. An example may be 2 years. And it also has a waiting period or how long you must be off work before payments start. An example being maybe 30 days. But IP generally provides cover 24/7, not just while you're at work. IP, though, can be offset by other disability income whilst you're in claim. Example being if you're receiving workers' compensation payments, they could reduce what you're paid under your income protection benefit. So the next question is, why have insurance cover? Well, insurance is just there if something happens. Now, this is one of the things that I find people struggle with the most. Why pay for something that I may never use? Well, to be honest, we hope that you never need it, but it is important to think about what situation your family are going to be in if something does. If you have sufficient assets to be able to cope, then we call this self-insurance, and you may need no cover at all. But if you know that you will not be able to cope financially, or the people you leave behind may have to sell the home they live in, then you do need to think about it. Now, a common misconception is that insurance companies rarely pay out. In the table here, MoneySmart have provided some data on claims history over the period 1 July 2024 to 30th of June 2025 for insurance that is held within superannuation. It shows that a high percentage of claims are actually paid out and within a reasonable time frame. Some of the reasons claims might not be accepted are that there could be exclusions to your policy. You may not have provided correct information to the insurer when you applied for the policy, or you may not have provided the information required by the insurer when making the claim, or you may not meet the conditions of the policy. So it is important to read the product disclosure statement and insurance guide so that you are aware of the things that can affect your ability to make a claim. Now, how much cover do I need? This is a difficult question and one I cannot answer today because the type and amount of cover you need depends on your own individual situation. Generally, you're likely to need more cover if you have a partner, children, or other loved ones who rely on you financially, a mortgage or other debts, regular financial obligations like school fees, childcare, or rent. You may need less cover if you have savings, superannuation, or other investments. You're single with no dependents. You have other people in the household bringing in an income, and you could continue to work if you couldn't or were no longer here, or you have no debt. Now, when looking at an appropriate level of cover, some of the things that you might consider are: do you have a mortgage which you would like to have repaid in the event of your death? Things to consider here are whether you have dependents who will continue to live in the home and whether they could continue to make the loan repayments. Do you have other debts that you would like cleared, such as car loans, personal loans, credit cards? Another thing to consider is, do you have assets you can sell, such as a motor vehicle, for example, that can be used to repay a car loan? Would you like to ensure that there are funds to pay for a funeral? Would you like to provide income for your dependents? And if so, for how long? Would you like to cover your children's education, childcare costs, or provide them with a lump sum? And along with these questions, you also need to consider what assets your loved ones could access to pay for some of these things. Now, a permanent disability will change what the rest of your life looks like. It can also make life much more expensive. When thinking about an appropriate level of cover for TPD, it is worth taking into consideration some of the following things: repaying your mortgage and other debts so that you're not forced to sell your home, covering additional medical modification and rehabilitation costs, providing for the cost of a carer, or providing income for you and your family. Many people underestimate the importance of TPD cover. In the event of a permanent disability, it might not only affect your ability to earn an income, but the ability to earn an income for the person who's left to care for you. Now, things to consider with income protection. With income protection insurance, you're only allowed to cover a portion of your income. So things to consider when looking at income protection insurance is how long you can wait before needing access to this insurance. This will determine your waiting period or how long you need to be off work due to illness or injury before you can make a claim. If you have very little sick, annual or long service leave, and you do not have access to additional financial resources, you might choose a shorter waiting period. If you do have access to leave and other financial resources, you may be able to wait longer before needing to access cover. So you may choose a longer waiting period. The other thing that you need to consider is how long you would like to be paid for. This is called the benefit period. Just remember, the shorter the waiting period and the longer the benefit period, the higher the cost of cover will be. Now, as mentioned previously, the amount of cover that you need depends on your personal circumstances. At NESS, we have an insurance adequacy calculator available online that can help you work out how much insurance cover you need. Details of where you can access this are on this slide below, but it's simply a matter of going into the NESS website and going to Tools and Advice, and the calculators are in that section. So, what impacts the cost of cover? So when considering the level of cover you should hold, it is important to understand that there is a cost to hold cover. The higher the level of cover you hold, the higher the cost of premiums will be for life and TPD. The older you are will also impact the cost of cover, as you're considered a higher risk. That is, you're more likely to have a medical condition or issues which could result in death or disablement. With income protection cover, the higher the monthly benefit, the higher the cost. Shorter waiting periods are also more expensive than longer waiting periods, and longer benefit periods are more expensive than shorter benefit periods. So what insurance cover do I have with NESS? When joining NESS, you may have been issued with default cover. This may include death, TPD, and income protection cover. Now, default, death, and TPD cover is what we call unitised cover. So when joining NESS, you may have been issued with 2 units of default death and TPD cover. The value of a unit changes over time. So when you're young, the level of cover is low, as most people do not have mortgages or dependents. And as you get older, the level of cover generally increases, and then later on in life, it reduces back down as mortgages are repaid and children leave home. What this does is it reduces the impact insurance premiums have on your super balance as you get older, because it becomes more expensive. Default income protection is available for members when SG contributions are received by NESS. It covers up to 75% of your SG income, and 12% is also paid to your super fund if you're unable to work due to illness or injury. The waiting period for default income protection cover is 30 days, and the benefit period is 2 years. Now, the cost of this cover is a percentage of your SG contributions, currently 2.6% of SG contributions received by the fund. Unfortunately, NESS does not offer IP cover if you are self-employed and you do not pay SG contributions into superannuation. Now, the good thing with NESS income protection is that premiums do not increase with age, making this very cost-effective for older members who normally cancel income protection later on in life due to its high cost. Now, to find out what you hold, you can log into your account online or contact our member services team on 1800 022 067. It is also important to note that default insurance is not specific to your individual circumstances, so the level of cover may not be suitable for you, and some eligibility requirements do apply. Now, under the law, insurance will not be provided if you're a new super fund member aged under 25 or your super balance is under 6,000 unless you actually request to opt into the cover. Now, NESS Super has obtained a dangerous occupation exemption from APRA, as a majority of members of NESS Super work in high-risk occupations. From 1 July 2024, NESS Super can provide default insurance cover to new members even if they are under 25 and or have a super balance of less than 6,000. So if you join NESS before 1 July 24 and you're under 25 or have a super balance less than 6,000, please contact us to discuss the process of activating cover if it's not already activated. Now, let's look at the tax implications of death insurance proceeds held in superannuation. As mentioned previously, the proceeds of a death claim are paid as a lump sum into your super account. They are then paid out along with the balance of the super fund to the nominated beneficiary or beneficiary if there's more than one. Whether tax is paid by the beneficiaries depends on whether they are classed as tax dependents or non-tax dependents. Now, the following people qualify as tax dependents, so they will pay no tax. A spouse or de facto or former spouse de facto, a minor child, that is a child under the age of 18, someone who is financially dependent on the deceased, someone who's had an interdependency relationship with the deceased. Now, one of the reasons we wanted to discuss tax is that it's not uncommon for our members to assume that their adult children will receive the money that they hold in super on their death, including the proceeds of their insurance tax-free. And this isn't always the case. Next, we'll look at the tax implications of TPD insurance proceeds held in superannuation. As mentioned previously, the proceeds of a TPD claim are also paid as a lump sum into your super account. They are then paid out along with the balance of the super fund to the member. So if you're 60 or over, then no tax is payable. If you're under the age of 60, then the withdrawal will be taxed. Calculations to work out the amount of tax payable are quite complex and depend on a number of factors, including when you last worked and your eligible service date. So when working out levels of cover, it may be wise to consider this tax to ensure that you're not left short. Now, with income protection, the money you receive from an income protection claim monthly is taxable income. Claim proceeds are paid directly to you into your bank account on a fortnightly basis with NESS, and tax will be deducted from the payment. If your marginal tax rate is higher than the amount of tax withheld, then you may also have to pay additional tax at the end of the financial year. Now, the main purpose of superannuation is to provide retirement benefits. It is not meant to fund large sums of insurance due to the fact that over time, the premiums will erode your superannuation and you may not have enough for your retirement. To reduce this risk, you should consider whether you should maybe hold some of your insurance outside of super and fund the premiums for this from your own cash flow, or make contributions to super to help pay for the premiums if it's held in super. Now, premiums for life and TPD insurance held in super are actually tax deductible to the super fund. So this can actually reduce the cost of premiums. But as I mentioned earlier, sometimes the proceeds of these policies may be taxed depending on who finally receives the proceeds or when they are received. Now, premiums for life and TPD insurance held outside of super are usually not tax deductible, but the proceeds are also not taxed. So you and your family will receive the proceeds tax-free, regardless of who receives the funds or when. Now, premiums for income protection insurance held in super are also tax deductible to the super fund. But if held outside of super, then the premiums may be personally deductible to you. And in either situation, the claim proceeds will be taxable income and taxed at your marginal tax rate. You also need to consider your needs, as you may not be able to insure for things outside of super, or as you may be able to insure for things outside of super that you cannot insure for in super. So if you want to make changes to your death and TPD, If you want to cancel or decrease your TPD or death cover, just contact us. If you want to apply or increase your death and TPD cover, once again, please contact. When applying for or increasing your cover, you are going to be asked about your occupation, any hazard activities or sports, and details of your health. This information will be used to assess your application, and you will be notified when this has been completed and the outcome of your application. So applying for cover whilst you're healthy is important, as certain medical conditions can make it more difficult to obtain cover. Now, if you wish to make changes or cancel your income protection cover, once again, please contact us. NESS does offer other waiting periods for your income protection cover. They offer 30, 60 and 90 days. And they also offer benefit periods of 2 and 5 years. So remember that SG contributions must also be received by NESS to receive this cover. If you're reducing your waiting period or increasing your benefit period, if you have default cover, then the percentage of SG contributions that we'll take out will change. But unlike death and TPD cover, you do not have to provide any medical information. This is because there is a pre-existing sickness and injury exclusion in place on the policy for the first 2 years. So as mentioned earlier, if you're an employee member with NESS, your premiums are calculated as a percentage of your super guarantee payments. So if your super guarantee payments are not received by NESS, then your income protection will cease. Thus, it is important that your SG payments are paid into a NESS and they are also received on a regular basis and they're not being paid late. The things that can affect your insurance cover. So one of the main reasons that death and TPD insurance cover is cancelled in super is the super account becomes inactive. What does inactive mean? It means that the fund has not received a contribution or rollover for a continuous period of 16 months. So super funds are required to cancel insurance cover in certain circumstances to protect your super balance unless you have informed them that you wish to keep cover. So it is important if you have a life and TB cover in your super that you wish to keep, that you let your super fund know you wish to keep this cover if they're no longer receiving your contributions. It is also important that if you do request to keep the cover, that you do have sufficient funds in your super to pay the premiums. Now, for income protection cover with NESS, the main reason cover is cancelled is because SG contributions are no longer being received by the fund or they're not being received on time. There are also other reasons why insurance might be cancelled, with the most common being your age. Death cover with NESS ceases at age 70 and TPD and income protection cover ceases at age 65. So as mentioned previously again, in the event of death, the proceeds of your death insurance will be paid into your NESS super account. So it's important that you have nominated who you would like these funds to be paid to. With NESS, you have the option of a non-binding and binding nomination. A non-binding nomination is not binding on the trustee, so the trustee still has the discretion to decide who to pay these benefits to. You can add a non-binding beneficiary by going online or by completing a form available on the NESS website. Now, a binding nomination provides more certainty over who will receive these funds in the event of death. But it must be signed in the presence of 2 witnesses and renewed every 3 years. You can only make a binding nomination by completing the form available on our website. And you can't just leave super to anyone. A binding nomination is only valid if the beneficiaries are dependents under super law, being your spouse, including de facto and same-sex, child of any age, adult children count, financial dependents, or someone in an interdependency relationship, or your legal personal representative. That is your estate. So it will be dealt with via your will. It may be best to get some assistance in this area from an estate planning specialist. They can take into consideration your personal financial situation and consider what is appropriate for your circumstances. So don't forget, our member services team is available 8:30 a.m. to 6 p.m. Monday to Friday to help with all your super and insurance needs. Well, that's the end of our session today. We hope that you've learned a little bit more about insurance with NESS.